Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, and Chris Englebert, Founding Partner and CIO of Englebert Financial Advisors. We're here to discuss key themes to watch in 2026 and why the market environment could be a return to normal. It's great to have all of you with us. Welcome back to Trade Talks, and Chris, return to normal, certainly a subjective feeling, isn't it?
Yeah, it is, Jill, but now we're going to be in 2026, 6 years out from COVID. COVID, again, sets the standard. When historians take a look back, they're going to be saying, well, wait a minute, what was happening economically then, and how are we getting back to normal? And we think the two biggest areas are the yield curve. We're going to get lower short-term rates. Obviously, the Fed signaled that, but we're trying to tell people you got to watch on the long end because inflation's not dead. The second big theme is the fact that it's not going to be all about the Mag 7. We're seeing that in the last couple of weeks. It's going to be the other 493 stocks. And so when I say return to normal, return to normalized markets. But there's one caveat we have for 2026 is that we believe there's going to be higher volatility out there. And the reason being is, Fed policy mistakes, and we are getting a new Fed governor. Valuations are still extremely high in certain sectors of the market. And also we have midterm elections. And so we had 20% drawdown in 2025. Everybody was, for that month was like, oh man, we're having a tariff tantrum. What do we do? Well, now, the market's recovered. They went on to new highs, but we're facing challenges in 26. It's not going to be after 3 consecutive up years in the market. Again, nobody likes to hear that investing is kind of like gambling, but, we got a lot of blackjack 21s going on here, and we are concerned going into 26.
Speaking of 21s, right, what's Nasdaq 100 up about roughly 21%-ish since the February or whenever the tariff tantrums are?
Right.
Yeah, April, I'm sorry.
Yeah.
Getting double digits starting with a 2, for a number of years in a row is
very unusual.
It's unusual, and look, as a long-term investor, I'll take that.
Right.
Especially having acquired shares of my 401k at less expensive levels. So, I guess you could include that as part of the cycle. Michael, turning to the macro for a minute here, it seems to be the focus is really on jobs and what those numbers are translating to.
Yeah, we got a big double update this morning with the October and November numbers coming out all at once because of the government shutdown earlier this year, delaying those numbers. And it was pretty much as expected. The headline looks a lot worse than it is. So for October, it shows just over 100,000 jobs lost. That's because 160,000 federal jobs were lost. But again, that was something that we knew going into it for the most part, and that's because that goes back to those buyouts that were initiated back in the end of January, where they paid workers through September. So those people that accepted those buyouts, they fell off the payrolls in October, and so that's why we saw that 160,000 drop in those federal workers. And so the private number is actually positive, about 60,000, and then for similar range for November as well. So it's not too bad, and if you look at the last 3 months, it's about 75,000 private payrolls added per month. So it's not blowout numbers, especially if you take into account what Fed Chair Powell was saying last week, where they think that the jobs numbers are overstated by about 60,000 in their initial prints. And that goes back to the annual revisions that we have based on kind of wonky birth-death models that they have for businesses, leading to kind of a persistent overstatement. So it means that we're still seeing job gains, but not huge job gains. The positive story, though, is that if you're looking at the surveys that small businesses do, that the regional feds do, those show some improving trends in hiring plans as the hope for 2026 is we're getting these tax cuts, we're getting lower Fed rates, there's reduced uncertainty, and all that combining to a little bit of improvement in hiring as well.
Yeah. Chris, it's interesting when we talk about returning to normal and we're 6 years out from COVID, right? There was no roadmap.
It doesn't seem like
right? But there was no roadmap. But guess what? We also went through the financial crisis. There was really no roadmap for that either. And yet the markets continue to do what the markets continue to do over the long term.
It's definitely a risk-on environment for the last 3 quarters, right? Especially since the tariff tantrum. You've kind of worked through a lot of different items, economic uncertainty, inflation being a little bit more persistent towards 3% than 2%. uncertainty out of Fed policy, uncertainty out of policy out of the White House, and then global macro across the board. But when you look at it, it's definitely risk on. You've had 36, 37 new higher highs in the S&P 500. You're seeing the rotation of smaller caps, especially in the back of 3 cuts. The Russell has been on fire. It's making highs again. The Nasdaq 100, the composite, the Dow Jones Industrial, 18 new highs this year. So you're seeing it across all sectors, across all market caps. That means it's risk on. I read you guys probably saw it today, the BAML report this morning for December Global Fund Managers, and it's showing the most bullish reading since 2021, and cash is at the lowest, 3.3% since that time frame. That's generally a sell signal for most folks. So what you're seeing is that the retail investor, institutional investors, everyone across the board is, in fact, in the marketplace where we are right now. And that macro theme is kind of interesting. You're seeing the data finally getting caught up after the shutdown, but more importantly, the main theme is still AI, but now you're seeing a broadening to the other sectors and starting to catch up.
Yeah.
So the question with the AI theme now is ROIs, which we were talking about before, and then a lot of the build. So the infrastructure play there is a little bit in question right now, especially on the ROI for that as well.
Of course. I mean, these companies have to be able to justify their investments and figure out what, out of the 1,000 use cases, which two are going to show the most value.
But on the good part about the AI part, and this is everything everybody already knows, that the companies at the forefront are using their own cash. They're using profits. They're not borrowing for the most part. It is a little mixed together, shall we say.
Circular.
Circular is a great word that everyone likes to use. I was trying to think something else, but.
Well, okay, Chris, here's an interesting question. In terms of how RIAs are using AI, is it a story of the haves and the have-nots? Are you seeing value to those who are using it, or vice versa?
Well, I feel like we're on the precipice where I always tell people, when you're a registered investment advisor, there are 2 parts to your practice. There's the part of getting getting prospects, converting them to clients, bringing the assets in, and then there's the section where you have to actually manage the money. And I feel like we're we're looking over the edge, like, hey, what can we use to get new clients in? I mean, there's a lot of products out there, database scraping, email, et cetera, to kind of identify your perfect client. So those are there, but the question is how do you use that? And in some cases, I mean, I'm not a politician, but if I was running for office, I think in the next couple of years, just like we have to be very careful with our medical information, your data that's out there is now being scraped and sold to God knows who. And at some point, people are going to go, hey, no mas. One of the most fun things I've been doing in the last couple of days, and this is my New Year's resolution, is to unsubscribe from all of those emails and texts that you're getting that I never signed up for it.
And they just come back, they're like cockroaches.
Yeah, they come back. So, my point is that AI is close on acquiring clients. I don't think we're there yet. But then also on managing portfolios, I've looked at a lot of software packages, interviewed them. It's also close, but it's not quite there yet. I don't care where we go with artificial intelligence, you still need human intelligence eyeballing it, going, does that make sense or does it not make sense in this particular situation, especially for individuals. I mean, we have a good sized practice. We focus on law enforcement, but everybody's the same, but yet everybody's situation is different. And so you can't say with AI, hey, everybody's should be maxing out their 457 or 401k or doing this. You still have to look at each person on an individual level, which we're not there yet with AI.
I would say a third component too, regardless of where we are with AI, as a fiduciary, there are things that you need to comply with, whether there's regulation in place for that or not. The guardrails that are there, you need to comply with. And if AI makes a mistake, it's still on you.
Absolutely. And I don't really think people have thought through the process of the guardrails. And like I said, I think we're going to have a big privacy data situation coming in the next couple of years, because people are going to be like, my data's all over the place, and AI is, all of a sudden, you probably were within months of you getting a phone call sounding like it's somebody going, hey, Jill, I saw that you were looking at XYZ on Amazon. We have a special today on that. I think that's where you could end up crossing a line.
Well, I mean, which is so interesting, Chris, because I have an Apple Watch on. A number of us, have fitness trackers. Was your first thing about your PHI, your personal health information, when you're inputting your stats and the goals that you want to achieve? That's a direct HIPAA violation, but not on the consumer side of things. There is nothing to regulate that. And
it brings up a caveat, because they're going to expand, just like all the other expansions you've seen over time into data security issues. They're going to push as far as they can until somebody pushes back, and we're not there yet.
Right.
Yeah.
And because they don't know what they have and what they don't have. And that's the whole point. Just going back to the market itself, what's the ROI on the investment? We don't know what that's going to be, but we know there's going to be something at the end of this yellow brick road. Hopefully it's something that's going to pay everybody back. And if that's something that we have to push, it's definitely something that they're going to do.
Yeah.
It just makes me scared.
Yeah.
Same as you, Chris.
Well, Michael, all right, let's talk about inflation for a moment here, because what I'm hearing anecdotally seems to be very divorced from the data that we're seeing and what's happening in the market, right? All I hear about is unaffordability and insurance, electricity, prices at the food store are so much higher. It seems very divorced from this, this good feeling that we're having here.
Yeah, I mean, the data is saying, inflation is close to 3%. But the reality is, if you're looking, that's talking about just the last 12-month period. But we're six years out from COVID, right? And in that COVID period, it's more like 25–30% that prices have gone up. So even though they're not going up as fast, they've just gone up so much in that last 6 years. And prior to that 6-year period, we had a few decades of really low and steady inflation. And so people just weren't used to it. And even though we've had, people are surprised to hear that wage growth kept up with inflation, but it didn't really surpass inflation that much that people are feeling. They feel like they're kind of running in place, right? It's been 6 years where you're not really any better off than you were if you're looking at aggregate wage data and aggregate inflation data. And so I think that's really where the disconnect is, where inflation's generally heading in a positive direction, lower, especially if you strip out goods inflation, if you're focusing on services. And I think the forward-looking data for goods inflation as well is relatively positive. If you're looking at PMIs, the prices data that they have in there suggests that that peak in goods inflation is only a few months away. So we'll start seeing goods and services inflation both slowing down, but that doesn't change the fact that the aggregate increase in prices that we've seen over the last several years is so much out of the norm from what people were dealing with.
I want to make a point to that. One of the things that we are hyper focused on in 2026 with the inflation is that if I was the Fed chairman, I would be watching crude oil futures like a hawk. They've been breaking down recently. If crude oil continues its descent, that's going to be really good for inflation. The question is, does it tip over to deflation, where prices keep cascading lower? Now, having said that, if we get gasoline, and gasoline right now in some parts of the country is $1.79 a gallon, which is very low. Oil is an input to everything manufactured, et cetera. If you can take away a big chunk of inflation with that, having rents come down, keep labor steady, maybe we're in that nirvana. I don't know if we are, but again, the Fed policy mistake, a new Fed governor in 26, and what's he going to do? And if he's saying, well, we're going to keep on bringing, short-term rates down, we don't care about inflation, that works as long as the price of oil goes down. But if it doesn't, and if there's some other drivers out there, then we're back in that inflation boogeyman for 26.
Yeah.
I mean, the Fed fund futures are pricing in 3/4 point cuts for next year already anyway, regardless. So if that does happen, and there is a policy mistake, it could be a major problem for the markets as a whole. But and will the AI spend be enough to pull everyone forward right there? So it's a big item to watch.
Well, I mean, your key sectors on the desk are retail and consumer. So we've heard about what the data's saying. We're here, we've heard about what we think the market's going to do. What are our issuers telling you?
So a lot of it's been very interesting. There's still, going back to inflation, the still significant uncertainty around tariffs and how that's going to impact the consumer. You still have the K-shape on the consumer spend, right? The wealth effect is definitely there for higher earners with the portfolios and the home ownership, and the lower income earners are definitely suffering a bit here, doing without. There's been a downturn for some items, which is kind of interesting. Some of the store brands are not seeing the action that they thought. The prices have been a little bit higher than thought, so people are doing without on that end. You are seeing dollar stores do better. You're seeing off-brand like Ross stores and TJ Maxx doing much better.
They always do better.
They do. Well, because they're Dollar Tree, Dollar General, and the dollar stores are sourcing a lot of it outside the U.S. And they've finally figured out the supply chain, and they're seeing better margins because they're monitoring their inventory, and they're doing much better. When you're looking at the discounters, they're buying supply that's already in the U.S., so they're not affected by tariffs. So they continue to do well, and people like to go for the treasure hunt when they walk into those stores. So that's still there, especially at this time of the year. What you're seeing in staples. So Walmart's now Nasdaq listed, and it's trading at all-time high split.
Congratulations.
Thank you. The team worked hard on that. I was not part of that team. But they're seeing brand come across. So they're seeing omnichannel, digital, two of the main items that have been working well, plus they're seeing a trade-down effect from the higher income earners shopping at that store, making the dollar go a little bit longer for the brands that they want to get, and not necessarily on staples, but also on discretionary. So you're seeing a lot of good import there. It depends, though. There's going to be lots of winners and losers, as you can see with a number of other companies as well, who have been big name brands are being hurt because there is no trade down in their portfolio for the products that they have.
Yeah, yeah. Well, Chris, it's interesting. I mean, retail's always going to be idiosyncratic, right? And then, you know, the long-term strategy over the past decade that Walmart instituted was brilliant, right?
Yeah.
I mean, they're worth the price that they're at.
Yeah, Amazon, Walmart, category killers. I mean, you see, you know, you go to the mall nowadays and you know, you see all the different stores that are empty and they're repurposing malls into other things that you can do where you have a lot of parking, et cetera. And so people are becoming even more savvy. Now, I talked a little bit about how AI has some negative aspects. To me, one of the biggest aspects, positive aspects, is ChatGPT for comparing prices and, you know, going on the internet and say, show me the 10 best prices for cars in our particular area. I think, you know, the search engine companies, whether, you know, is Google and Microsoft going to be able to retool so that, you know, consumers can really hyper focus on what the really good deals are out there.
Yeah, you know, it's interesting that you're talking about repurposing traditional malls. I mean, Walmart, are they anchoring some of them now? Or you're seeing more lifestyle, like gyms or big box stores starting to anchor them versus traditional department stores?
Yeah, and that trend continues. I mean, the consumer, you know, when the day is done, the consumer is always extremely savvy. They know where they're going to spend their dollars, and they drive the U.S. economy. And so, again, one of our other themes, and obviously we have to wrap up here, but we've been pounding the table on small mid-cap stocks, and we think 26 is finally the year. We saw it at the end of the year, but again, onshoring manufacturing, lower short-term interest rates, you know, things like AI go right to the bottom line for small mid-cap companies, and you know, we think that theme finally plays out in 26.
All right, and we will wrap it there. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.